Okay, we spend most of today looking at the markets in 2016. Later on in the program, we will revisit the final Monetary Policy Committee communique of 2016. That was in November with the MFLA Central Bank, recapping the decisions and the considerations of that body for you as we wrap up the year and look at the first MPC meeting in 2017. That will be in the third week of January, less than a month from now. So you need to keep these things at the back of your mind as you plan for the new year at the government level and at corporate and individual levels. But first, let's bring you this news, if it will make everyone a little bit happy, that the Nigerian government, President Buhari's fight against ghost workers is yielding results. The sum of 143 billion naira has so far been clawed back in 2016 due to overpayments of salaries on the federal payroll due to ghost workers. But the icing on the cake was that a syndicate of 11 people, according to the government officials, have now been arrested. They are called the arrowheads or the kingpins of this monumental fraud on the payroll of the federal government. They've been arrested and are handed over to the Economic and Financial Crimes Commission, or the EFCC. We'll wait to get further details on this part of the news. Of course, the government, the finance minister, who's you've seen her picture there on your TV screen, has always talked about how much the government is reining in, cleaning the books, and making more money back from ghost workers, thousands and thousands and thousands of them. But now 11 people are said to have been arrested in connection of that. They are the cartel, or the cabal, as it were, responsible for that. Quickly, let's look at the oil and gas stocks on our market. This was how things finished off on Friday. The big boys in that space, the big seven, as it were, dragged down that market, side of the market for the week, as it were. Friday was a little bit green with 40 oil, 10.24%, going back to triple digits, 103.87 on 303,000 units. Corn oil shaved about 5%. We saw some gains about 2 weeks ago, 37.48 at the closing bell. Mobile finish unchanged, 280. That was a gray shoot. MRS sitting at 43.24. Look at Owando, 4.5, 4.50. 2.74% to the north, 1.758 million units. Seplat, the only oil and gas production and exploration company listed in Lagos and London, 370.5. Flat with 818 units. That's lackluster. And of course, Total also up 2.49%. A green shoot, 284 at the closing bell, 219,873 units. For the week in summary, this is what it looks like. All in the red. Again, because the market, those stocks went down aggressively in the early part of last week. 4.66% for that oil and gas index return for the week. That's shaving the year to date to 11%, as you see that. Price to earnings, 38.5 against the broader market, 14.5 multiples. And the dividend yield back slightly because of the Friday gains by the big boys, 40 oil and Total. Dividend yield went back to 2.0%. Let's get back to the marketplace. Well, we're sticking with the marketplace, am I? Yes. Then we'll get back to the discussion around the markets in 2016. Let's continue to flesh up on the portfolio assessments and the asset classes across our market. We're just very few, but we're going to keep this up. Let's get some other perspectives into this conversation. Omotola Abimbola is an investment analyst at Afrinvest in downtown Lagos, Ikoyi, and he's joining us via Skype as well. Omotola, good morning. It's good to have you back on the program. Thanks for joining us after the Christmas holiday.
Good morning to you, Boasen.
Yes. So let's start from here. Did you get some cash on Friday? Look at Interbank, 20% to the north. Folks were sitting on the floor on Friday in banking halls across the country. The ATMs were also besieged. Did you get some cash, as it were, or did you go through one of those experiences? Or you already have some cash under your suitcases, in your suitcases, under your pillow, under your mattress?
Well, I think I'm one of the 21st century compliant Nigerians, so we've gone cashless. So you really don't need cash to do lots of things now.
Yeah, I don't expect someone like you to be found sitting on the floor of any banking hall. You will load everything just on a card, and there you go.
Certainly.
I envy you guys who are 21st century, the baby boomers. Everything is in the head and on the card. Interesting. Okay.
Oh, definitely.
No, seriously speaking, as far as the markets was concerned, this year, the stock market, well, not entirely a write-off, but, well, so, who made money and who lost money?
Well, I think for all asset classes, it was a very, very bad year. Talk about equities, talk about bonds, talk about currencies as well. The Naira lost more than 30% against the dollar, looking at the official exchange rate. For the parallel market, it's probably a lot more worse. For equities, the market is down 7.5% already year to date. Could probably reduce to like 5% or 6% before the year runs out, but still, it will be the third consecutive year of negative return for the benchmark index. And the factors driving this, they are all known. They are mainly macroeconomic. Fundamentally, profitability of companies weakened significantly in 2016 due to the weaker macro backdrop. Most companies struggled to grow revenue due to low growth environment, and cost of production was increasing as a result of the inflationary pressure in the economy. And then for most companies as well who had lots of external leverage, that is foreign currency leverage, they were booking very high FX losses. So as a result of that, fundamentally, the equities market was very challenged. And then sentiment as well, because of the FX policy of the central bank. In 2016, the pricing of equities wasn't that good as well. So we saw that most foreign portfolio managers, they exited the country, since 2015, and they didn't return in 2016 as well. In Q2 to Q3, we had a short-lived rally driven by the adoption of a flexible foreign exchange regime. But of course, afterwards, the market found out that there was still a bit of manipulation in the currency market. So that essentially doused sentiment in the equities market. Talking about the winners, I would say that banking stocks appear to be the best performer of all the other sector indices in 2016. The oil and gas index is down more than 20%. Oil and gas, the banking index is down less than 1%, and that's mainly due to the fact that we had a rally in tier 1 banks, between Q2 and Q3. So for the likes of GT, for the likes of Zenith, for the likes of UBA and Access, they were the ones that mainly drove the banking index, to a fairly decent performance compared to the other sector indices.
Yeah, so in other words, if we're looking at a single-digit negative index return on the equity side for 2017 or 2016, thanks to basically oil and gas and the banking stocks, do you think consumer goods and industrial goods weigh in a little bit, try to moderate things? Look at 2014, 16.1%. 2015, 17.4% negative.
Yeah, of course. Compared to the previous years, 2016 was still very decent. We are down by less than 8%. For the industrial goods and the consumer goods sectors, I would say that in 2017, there might probably be a rebound in both sectors. The industrial goods index is down by more than 20% now year to date. And that's mainly due to the fact that Lafarge was heavily sold off, on account of the fact that the company has lots of external foreign currency leverage. So they were booking very high FX losses, which led to, to the company to record a loss, before tax losses, in 2016 so far, at least for 9 months results. So going forward, there will probably be a change in sentiment for the cement industry for 3 factors. Number one, cement prices have gone up by more than 30%, so that's very positive for margins in the industry. We also have most of the companies in the sector now trying to improve their cost profile by trying to adopt more efficient sources of energy. So Danksem, for instance, the company has installed coal plants across all its production facilities in Nigeria, which reduces its dependence on gas, which has been very volatile in 2016. Also, for Lafarge, for instance, they've embarked on a campaign to try to restructure their debt. So they've converted a very good portion of their foreign currency debt into equity. So going to 2017, there'll probably be a change in sentiment, for the cement sector as a whole, driven by both fairly decent performance in revenue and much more lower cost profile in the new year.
Yeah, and the fact is also spinning off Ashaka Cement as well to delist from the stock exchange. Perhaps that's just one of the burdens they are trying to shake off and get a little bit smarter, perhaps bigger, as Dangote Cement. But again, let's talk about agriculture side of things a little bit. Thanks to Godwin Emefiele, the central bank banned on 41 items, FX for palm oil, finished, refined, petrol, oil palm products imports into the country, and we saw these two companies listed on our market quite aggressive in 2016, Okomo Oil and Presco. So do you think the success stories for these two will continue in the next year?
For Okomo and Presco, I think they are very positive growth story at the moment. Government regulation, as you mentioned, is presently favoring them. Beyond that as well, because of the largely, on the local capacity to fulfill demand for oil palm. So these companies have seen a growth in their market share in their industry. Also because of the fact that we now have much more tighter access to foreign exchange. So most domestic, end users of oil palm, they have resorted to, actually buying their core inputs from these two companies. So going to 2017, it's probably going to be a very, very good year for the two companies as well.
Okay, Omotola, let's put everything together in a basket. Who makes money and who loses money in 2016? Foreign portfolio investors, local portfolio investors, the big boys, as it were, or the retail investors?
I would say everybody lost money. For the foreign portfolio investors, they probably had the worst performance because looking at the dollar return of the benchmark index, we are down by over 30% now. For LCY, we are down by less than 8%. So in that regard, they've probably been, much more impacted by the downturn in the equities markets and, of course, the weakening foreign exchange. But I would say that, referring to different asset classes, I would say T-bills investors are probably the biggest winner of the year because when you look at the broader classification of assets, currencies, if you are long on the naira at the beginning of the year, you're probably down by more than 30% already. If you are long on equities at the beginning of the year, you're probably down, depending on the diversification of your portfolio, probably down by around 7-8% already in 2016. If you are long on long duration bonds, you're probably down as well. The 10-year government bond yield at the beginning of the year was around 12%. Right now, the 10-year government bond yield is above 16%. So you've already lost money because when bond yields go up, prices are coming down. So you've lost money in that regard. But if you're a T-bills investor and you play this very short, you do 90% and you keep rolling it over, throughout the year, you're probably, very much in the green by now. So I would say that by asset class, if you're a T-bills investor, you're probably spending to the bank now.
Tola, finally, in 1 minute, where can I make money in 2017? Have you guys thought about it? Are you thinking about it? Where can I make money in 2017? And I'm not talking about MMM. And I'm not talking about MMM here. So, where can I make decent money, legal money?
Boston, I trust you won't do MMM. You're a 21st century compliance investor as well.
No. I'm one of the old horses here. I'm an old dog. You can't teach me new tricks. So, what asset classes, what portfolios should folks out there think about making money in the Nigerian market 2017? 1, 2, 3.
Okay, for now, what we are telling our clients is this. If you want to invest in 2017, you're going to have to do two things. You have to overweight on fixed income because we still think that equities might still underperform in 2017. Maybe not a negative return, but probably a flattish performance if things continue this way regarding the FX policy of the federal government. So, number one, you have to overweight on fixed income. Number two, if you're doing equities at all, they ought to be very defensive portfolios. You can't do growth stocks now because the environment isn't conducive for growth companies. So you're going to have to do highly defensive stocks with low volatility, trading within a very tight band. So I'm talking about doing market leaders across sectors, Dangote Cement in the industrial goods, in the banking sector, do the normal tier 1 banks, GT, Zenith. These are, very, very familiar names, very good cost profile, and they've delivered fantastic return over the years for investors. So stay with market leaders, and the defensive stocks in equities.
Thank you, Tola. Eat what you know. Anytime you get to the lunch table, or if it's a buffet, just stick with what you know. That's what you're saying. Thank you very much. Do have a great day, and see you soon in the new year. Motola Abimbola from Afrinvest. We'll be back after the break.